We are looking at markets rallying now. This has been an equity all green situation through this morning. In a significant development this weekend, the United States and China have agreed to a temporary trade deal. Negotiated in Geneva in Switzerland, the two countries will be drastically reducing tariffs on each other's goods. Announced initially this 90-day pause, this is a pretty major de-escalation, and it demonstrates that both countries want to focus on easing the escalating tensions seen over the last few months. So ultimately, what would this announcement, what does it mean for U.S. and international markets going forward? Joining us here to unpack the macro themes on his radar and setting you up and putting all of these moving parts into context, including your trading week ahead, is Fidelity Director of Global Macro, Jurrien Timmer. Welcome, Jurrien. You've got a huge travel schedule right now. It almost fits the headlines that actually are coming out. So we're delighted you could make it here to join us today. Welcome.
Yes. Well, good morning. Thanks for having me. And yeah, there's never a dull moment, especially being on the West Coast where I am for a couple of weeks is because of the time difference. It's like, I don't dread waking up, but it's like when I wake up, I'm like, what kind of barrage of emails is waiting for me, either for like TV requests or breaking news or this or that. And today was no exception, as you just pointed out.
I can imagine, because I mean, also when you're waking up at that hour, which is probably still very early, the day's already begun, and the day really began in Europe too. So it's that much further ahead to you. So just tell us a little bit. The Chinese U.S. negotiations, by all accounts, or by most accounts, got further than perhaps many observers thought. We also have the pharmacare announcement on top of that. So just give us a little bit of what the market reaction is reacting to, because there's a lot in there right now.
Yeah. So the news is that the 145% tariffs on China are being paused for 90 days. So we go back to the tariffs that were already announced, which is the 10% on everyone, plus the 20% kind of that fentanyl-based tariff. So the tariffs are down to 30%, which is still 30%, but it's obviously less than 145%. So that is the good news, and of course that comes on the heels of the last few weeks of other more onerous tariffs being walked back or given a pause. And so what this does for the market, of course, it's this constant back and forth of the markets freaking out about how big the left tail is and how fat that tail is in terms of what it needs to price for. And then all of a sudden, the tail is not as pronounced or not as likely, and then the market rallies. So that really has been kind of the dance for the past few months. After the election, it was like, okay, we're not worrying about tariffs. We're just going to play on animal spirits and rally. And then, of course, the tariffs talk started to become more louder, and then the market started to price in at least a slowdown, if you will. And then from the slowdown, the market started pricing in something worse. Not quite a recession, but certainly a more severe slowdown. And actually, we can pull up slide 5 here. And that was, of course, back in April and March, where then all of a sudden the S&P was well below its rising trend line. And at that point, the market had priced in a fair amount of bad news. And it did so knowing or thinking that, the kind of the historical Fed put that we, at least in the last few decades, have been able to rely on might be not there anymore or further out of the money, just because the Fed is not inclined to cut rates as much as it might have done in the past, or as much as the White House wants it to. But then we got a put from a different direction. We got the fiscal put instead of the Fed put. So it's a matter of, if you look at that yellow band there on that chart, it's sort of this pendulum that swings from the top to the bottom on that rising trend line. And the bottom is sort of a severe slowdown, not quite a recession. The top is, hey, everything is great. And the middle is, we're pricing in for some sort of slowdown, but nothing worse than that. And the news today out of China or Geneva, I should say, puts us firmly back in that, okay, there's going to be some slowdown, but it's not going to be serious. So the market has already priced for that. The P's have already come down. The earnings estimates are already getting marked down a little bit, and all is well. And that's where we are today. Now, how long that lasts, of course, is anyone's guess. And if we go back to the top of that range or even new highs or the old highs, then you start wondering about, okay, we just had good news with this administration, the next tape bomb, as we used to call it on Wall Street, is never far away. So at that point, do you take some chips off the table and do you rebalance maybe out of equities into something different? But that's a conversation for another day.
Yeah, well, and maybe we will ask you about sort of the discussion of asset allocation a little bit later. One other thing that is coming this week, well, we did have the Fed decision, non-decision, good job saying nothing, which I think was his intended probably role there, and you can comment on that. Further this week, we do have discussions, we think, between Ukraine and Russia. We don't know. But in terms of the put that you've been talking about, I'm just sort of curious what sort of put there might be there. And again, a little bit of a best case, worst case. We don't need to spend too long on it, but it's a major development if it does in fact happen.
Yeah, and so speaking of puts, let's put up slide 1. And again, when this market started to go south back in March, there was a sense that there is no put, right? There's no Fed put because a trade war would be both inflationary and contractionary, so that would leave the Fed hanging in between its dual mandate. So there would be no easy fix from the Fed. And at that point, the rhetoric coming out of Washington was so fierce, even with the president and his advisors saying, like, we don't really care about the stock market. We care about bond yields. And if the stock market goes down, if we get a recession, then that's the price we're willing to pay. So that tells you there's no fiscal put either. And then the markets did exactly what they were going to do, which is to go in a tailspin. And at that point, all of a sudden, there was a fiscal put, not a Fed put, but a fiscal put. And so the reason that I mention that is if we look at the analog shown on the chart here, and we look at what has happened in the past, so going back 100 plus years,
wow, 100
when
plus
the
years.
S&P has fallen 20% from a high. And you can see from the chart, it's a hot mess, right? Sometimes the market keeps going, sometimes it immediately recovers. But the most bullish scenario in that set of occurrences was the 2018 pivot party, as we call it, right? So Powell was tightening rates in 2018. The 10-year went to like 3.5. Seems quaint now because we're at 4.5. But at that point, that was a lot for the markets to swallow, and the Fed pushed too far, and we had that fourth quarter 20% shakeout or shakedown in the markets.
Right into Christmas Eve. Do you remember that? It was like trading right into sort of the holiday of the holiday. Yeah.
Yes. And the market bottomed on Boxing Day, which, of course, Americans have no idea what that is, but that is second Christmas Day for us Europeans, and I'm sure in Canada you know that as well. And the market recovered because the Powell had pivoted, and we had this massive pivot party. Now, it seems unlikely that we would have that because there is no Powell pivot this time, but a put is a put, right? Whether it comes from the Fed or from the Treasury doesn't really matter. And because what matters is that markets are pricing in for a worst case scenario or a bad case scenario, let me put it that way, and then that bad case scenario is removed. And again, that comes back to my earlier point about you price in a left tail, the likelihood of it, how deep is that left tail or how fat is that tail, and then it's just kind of this rotation back and forth to that sort of that third rail scenario, that hot stove you don't want to touch, but occasionally you want to touch it, and so it seems again hard to believe to me. It seems unlikely that we're going to keep following that purple line. But that's the trajectory that the market is on. So going back to a month ago when the market was down 21% and it seemed like, oh my God, this is going to be a bad one, we're following now the best case scenario, which is which is interesting. But my guess is that, the thing with analogs is they look great and then they fall away, because we were looking at the 1998 analog a while ago, and there's also the 1968 analog, which is that orange line, which remains just as potent as the pink line. So
tell us
we don't
about
really
that a
know,
little
but
bit, because that was a 3-year
but
period.
yeah, but these analogs are helpful in gauging the zeitgeist of the market, in terms of, you have different playbooks based on different amounts of fear and greed, and I think it does help set the stage of how the market is thinking about this. But to your question earlier about Russia, Ukraine, obviously that would be welcomed, but for the markets, I don't think it particularly matters, at least not the U.S. market. Certainly for the European markets, it might. But it also depends on what kind of deal there is and how that speaks to the geopolitical world order. So that's another whole separate conversation.
So that is a separate conversation. It's just something that's coming up, and it sometimes moves the tape, as you were mentioning. Something else that obviously moves the tape is taking a look at earnings, and the story of this earnings season has been things look fine, but of course that's a while ago, and we're trying to figure out what we're doing going forward. Take us to the earnings story. The valuation stories have adjusted. Some questions about the estimates going forward, but where are we when we sit in sort of the earnings story for the S&P 500?
Yeah, so let's go to slide 5 again, where we started, and you can see there in the bottom panel, the purple or pink is the change in the PE, and the blue is the change in earnings. So that's the trailing earnings growth. And you can see that, we're, unlike 2024, when both earnings were growing and PEs were expanding, 2025 has been one where the earnings side has held up, at least on a trailing basis, and Q1 earnings were very, very strong. But the PE is sort of offsetting that, and that's been my expectation all along, that 2025 would be one where you don't have that amplification effect of rising PEs, even though earnings would be okay. But again, this is looking backwards, right? So these are trailing earnings. So if we go to slide 6, we can see what's happening to the earnings growth estimates, and you can see there the black line, a massive bump in Q1 earnings. So Q1 earnings season, very, very robust, about a 500 basis points bump. But you can see Q2, Q3, Q4 towards the left of the screen, all getting downgraded, if you will. And then the question really is, how much of that is just the normal drift that you tend to see, right? If you look at all those gray squiggles, you can see that that's what normally happens, because earnings estimates start high and then they end up lower, because companies like to guide down earnings expectations and then beat the estimates. Oldest game in the
oldest marketing
oldest trick in the book.
Game, yeah.
And so it does look on the surface that kind of that growth slowdown is being anticipated because of a potential trade war. Certainly no markdowns greater than, certainly no markdowns that would be in line with recessionary expectations. Then you would see negative growth rates. But if we take a step back to this and we go to slide 7, I've got essentially this chart, but now going back about 40 years, from 85, when earnings estimates became a thing, to now. And these are the dollar estimates for the S&P by calendar year. And again, you see 25, 6, 7 all getting downgraded, but not worse than what we tend to see, right? So if we go to slide 8, here I just line them all up at the beginning of the year, and you see that the 2025 number is really not falling any further than the average would in any given year. So that's a long way of answering your question, but what it says to me is that while the market certainly is aware of that left tail, a growth slowdown, which might become a severe slowdown, which might become a recession, the earnings estimates really actually do not reflect that yet, because their declines for the next couple of years so far is not worse than what we would normally see in any year. And so that tells me that, I don't want to say that creates a risk in the market, but it tells me that, yes, we've had some valuation haircuts. Markets went from 22 to 19. Mag 7 went from high 20s or high 30s to mid 20s. But if we still get that trade war, or at least these pieces of progress with China and other countries don't come to fruition, there is still some downward pressure here on the earnings side that has not been fully accounted for, I think.
So there's a question, certainly the 60/40 question. I think you've gotten many questions about that, and I wonder if we can tackle that or ask you to tackle that. But just first of all, taking a look at something else you've talked about quite a lot, which is sort of if we have things going forward that are looking maybe a little bit worse, but not terrible going forward. Is it still the Mag 7 leading that charge, for instance? Like, what is leading the charge into a okay future, maybe not as okay as the last couple of years, which on a relative basis were extraordinary. What's leading that?
Yeah, so it's a great question. And so let's go to slide 11. So the big existential question for me, so beyond just the market cycle in the next few months, but really the next 5+ years, is will we get that rotation out of the U.S. into non-U.S. stocks that many of us on our asset allocation team have been sort of eyeing, right? Because it's if that were to work, it would be a tremendous opportunity set just because of the valuation differences, right? The US is at 22, or it was at 22. It's more like 21, 20 now. Rest of the world's at 14 PE. So you have a pretty big opportunity set, but you need a catalyst for that, right? So if we see the US here, S&P 500, obviously driven by the Mag 7, you can see two different trend lines. The yellow one is just for the current secular bull market that started, in my view, in '09. And you can see we're right on that trend line. Everything is fine. But then the longer trend line, we're well above it. And so if there is a baton pass from the US to non-US because of a global change in the global world order, even if it's not as scary as we thought it might be a month ago, but still, if countries like Germany and other regions start to invest more, and like China does the same thing because it now feels like it can really compete for capital around the global stage. What does that do to capital flows and to opportunities for growth? And so if the baton does get passed from the US here to now, the next slide shows the MSCI ACWI ex-US, so this is non-US. You can see that the rest of the world, this is priced in dollars, which is how MSCI does it, has not made a new all-time high since 2007.
Wow.
Which is pretty remarkable given that that's more than 15, 16, 17 years ago. And so obviously it's been good to be on the other side because this hasn't really worked well. We call this dead money in our business. But on the other hand, if that secular trend is starting to crest because maybe the Mag 7 have kind of done what they're going to do, and the rest of the world starts to break out, then you would look at this chart and say, wow, that's like a 17-year base. And if we break out from that, then that could be a secular regime shift. And if we go to slide 13, the timing of that would be really fascinating because, again, we've talked about the US secular bull market, how, in my view, that bull market is cresting. It's maybe not over, but it's certainly in very, very late innings. And you see there in the top panel the overlays with other secular bull markets over the current one. And then if you look at the bottom panel, which is the 10-year CAGR, compound annual growth rate, of various intermarket relationships. So you have US versus non-US, or I should say non-US versus US, value versus growth, small caps versus large caps, commodities versus financial assets. And they have followed kind of a 3-decade cycle, which is a very long time. But my guess is that if the secular trend turns for the US, all these other markets are going to outperform. Now, that might happen in an environment where there's not a lot of beta to be had, some, but not a lot. But certainly there would be an alpha opportunity. And so to me, this is potentially the big prize. And we don't know yet that it's going to happen because, as the previous chart shows, we don't have that breakout yet. But if it were to happen, you could see the geopolitical storyline behind, right? The US becomes more transactional, more inward looking, everything becomes a trade deal, but the US is no longer that sort of benevolent global policeman that makes the global economy better, maybe at the expense of its own middle class, but the dollar reigns supreme as a reserve currency, and all those dollars get recycled back into our U.S. assets, of which foreigners, by the way, own 30 trillion of them. And so, if that kind of large trend starts to sort of crest, then you could see an environment where the dollar becomes less important, still important, but less important. Fewer assets get recycled back into the US. And while at the same time, countries like Germany and Europe got that wake-up call saying, okay, we can't rely on the US to be our guardian, we need to do it ourselves. And so you add up all those things, and you could see the potential for an inflection point, and one that lasts more than a couple of quarters, but one that could last a number of years. And it's interesting, if we go to slide 10, this is the MSCI EFA. You can see the earnings, again, have not surpassed the 2007 levels, which is why price hasn't surpassed it. But we're getting close. And in the same time, if you look at that little insert there with the gray lines, the earnings estimates are now really advancing for the calendar years, whereas in the US, as we showed earlier, they're declining. And so we actually have finally a potential catalyst where earnings growth in IFA and the rest of the world is actually picking up, while in the US it's slowing down. And so a lot of really interesting things happening here that could provide opportunities, again, for a longer-term strategic asset allocation.
That is absolutely fascinating to see you lay it out like that, and the 30-year trend that may swing altogether back on the way up. A question coming in right now from the audience to you, perhaps right on top of that, is the discussion of what you think about as gold and hard assets and how they sort of fit within that story. Gold has obviously been the exception to everything this year.
Yeah, so let's take a look. Let's go to slide 16. So I think that comes to the larger question of, all right, what does a portfolio, what should it look like these days against what I just described? So the kind of the old 60-40 paradigm that I think we probably all grew up in from the late 90s until COVID or 2022, when the big rate reset happened, and that reset flipped the bonds to stocks correlation upside down. Before that time, all you had to do was 60-40 S&P, Barclays Ag or Bloomberg Ag, and you didn't really have to do much else. I mean, obviously, you're all in Canada, so you have the currency aspect that the U.S. investors don't have. But you didn't have to overthink the model very much. You would get a 9% CAGR with a 9% vol, and life was good. And then 2022 happened. The rate reset happened. If we go to slide 17, you can see, this is going to be very hard to read, but if you can see the correlation matrix of the S&P to everything else, and you can see how
it's the red bonds versus the blue, right? I mean,
yes. So the red is a high correlation. Right. The blue is a negative correlation, and again, it's hard to see. But bonds flipped from blue to red. Gold remains blue, as it always has been. And then Bitcoin kind of goes in between the two. And as we described it last week, Bitcoin has a Dr. Jekyll and Mr. Hyde personality that sometimes it acts like gold, sometimes it acts like the NASDAQ, and you never quite know which one is going to show up to the party. But in my work, I found that gold and Bitcoin, which actually are negatively correlated to each other, which I find amazing. Actually, slide 21 shows that if they're different players on the same team, see that? So this is correlations to Bitcoin, and gold is the most negatively correlated asset to Bitcoin, which is wild because they're both trying to do the same thing. So the way I think about it is, if we go to slide 23, is that 4 units of gold is the equivalent of 1 unit of Bitcoin. This is not investment advice, but the way I would think about it is because Bitcoin has 4x the volatility of gold. So if you normalize for that, so you take 4 units of gold, so let's say you allocate 5% of your portfolio to the store of value asset group, and you put 4 in gold, 1 in Bitcoin, or if it's 10%, it's 8 in gold, 2 in Bitcoin. That's how you normalize the two for each other. Now, they still take turns. If you look at the bottom panel, you see the Sharpe ratios for gold and Bitcoin. They've been on opposite sides because in the last few months, gold, of course, has soared while the stock market was down. So that means Bitcoin was down. And now those Sharpe ratios are converging. And now Bitcoin is running and gold is correcting. So that's how I look at it. So rather than having to choose, I just have both, but not on an equal footing, just because you need to normalize for the volatility. So that's how I think about gold and Bitcoin. But if we just go back to slide 19 for a second, and we look at Sharpe ratios over the last 5 years, both gold and Bitcoin are very, very competitive, as well as a bunch of different alternative strategies, whether it's market neutral, long short market neutral hedge funds or managed futures and things like that. And to me, that's how I think about portfolio construction, because I'm more interested in hedging the 40 in the 60-40 than the 60. So even though I think the secular bull market for equities is probably cresting, that doesn't mean we get out of equities. We just have to set lower expectations for the returns, because I don't think the stock market's going to go down. It's just going to do less well than it was in the past. And again, within that 60, all we have to do is swap out of the US into EFA, for instance, and we might still get strong beta, even if it's no longer coming from the old 60. But it's the 40 that I'm more interested in. And if we go to slide 20, if bonds are going to be a somewhat impaired asset going forward, right? We're at 440 today. I think we're much more likely to be at 5 or 5 and above in the next coming years than at 4 or below. Okay. That doesn't mean bonds are impaired. I mean, if you own them, you get a positive real rate of real yield, and they do well at certain times when the stock market wobbles, and that happened certainly last month. But generally speaking, if you look at the fiscal landscape, it tells me the term premium is probably going to continue to rise. And then it's a matter of, okay, on the 60 side, there's only so many things that are negatively correlated. Again, gold, commodities, dollar assets in general. But then we look at what's correlated to the 40 side or negatively correlated to the 40 side. And then we go to slide 18, and I know we're almost out of time.
We are, but let's go there.
And then you look at those correlations by year. Again, it's that very noisy chart. But you see gold and Bitcoin have either no correlation to bonds or they're negatively correlated. And that's how I think about gold and Bitcoin, as well as these other asset classes that I mentioned. It's less about the 60. I'm less concerned about hedging the 60 and more concerned about hedging the 40. So for me, a 60-40 is like a 60-20-20, where I take 20 out of the 40 and I put it elsewhere. I put it in cash, I put it in gold, Bitcoin, commodities, maybe floating rate debt like bank loans and alternatives like managed futures and long short equities, assets that strip the beta out and leave the alpha. And so that's how I think about the puzzle and how to put that puzzle together, not for the next 3 months, but for the next 3 to 5 years.
Fascinating to have you put that puzzle together in a way for us. We're very grateful for that, because it does feel like a lot of missing pieces right now. So thank you to you, Jurrien Timmer. I feel like there's a Gulf handicapped discussion that could fit with your Bitcoin normalizing for gold and vice versa. But anyway, that's for another time. Good luck on your travels. We'll see you soon. Thanks for joining us.